iTroops Mortgage Dad here, trying to make sense of the mortgage market, one little bit of information at a time for you. No advice on this channel, purely information, just trying to arm you when you're sitting in front of your mortgage broker or the internet or your bank. So, I've been in the industry since 2007, and there's one question which is the first question that people want to know, and that's basically how much can I borrow? So that's what we're going to kind of look at just now, is how banks would look at your borrowing entitlement. So if you're employed, it's fairly straightforward. Actually, that's a complete lie. Years ago, it was fairly straightforward. The lenders would give you a multiplier of your gross annual income. So if you were on 25 grand a year, you would get 3.5 or 4 times your gross annual income, less what you were paying to maybe car finance or credit cards. Things have changed slightly. Well, things have changed massively. What lenders look at now is what they call affordability. So your income obviously is the main driver, but they will look at your kind of regular outgoings, things that you'd normally expect to pay, like your grocery bills, your energy bills, but it even factors in things like how many kids you've got. So, I mean, kids are expensive. So if you've got 3 kids, it's going to have a big impact on how much you can borrow. Now, every lender will have an affordability calculator on their website, so you can plug the details in of your income, your expenditure, how many kids you've got, how much you owe on car finance, how much you owe on credit cards, and it'll churn out a figure, a broad figure that tells you on that basis, if all that kind of stacks up when you send all your paperwork into the lender, then they will be able to lend you up to X amount. Things that do impact significantly on how much you can borrow, I mentioned kids. Kids will put a big dent in your income. But they'll also look at your debts, so your outgoings, credit cards. Typically with credit cards, they will factor in payments of 3%, and loans obviously however much you're paying for them. Now, often if you have some savings or you've been gifted a deposit, somebody will maybe be helping you out with the mortgage. You might be looking to pay off some credit cards, some debts, just to make the affordability a little bit better. And not all lenders will take that into account. Some will assume that because you've had X amount of money on a credit card balance, even if you pay it off, you're kind of psychologically tuned into having that amount of money on a credit card, and you'll probably just run the debt up again. So they will factor in either a small remaining monthly payment, or they'll just disregard the fact that you're going to pay that card off completely, and they'll factor it into the affordability. So again, depending on your circumstances, depending on your kind of debt to income sort of ratio, that would kind of drive which lenders that would be suitable for you. The other thing that they'll look at is how your income is structured. So if you're on a basic salary, brilliant, it's nice and simple. But if you have overtime, or you get bonuses, or you have allowances, all of these are looked at differently. There's very few lenders will use all of your income if it comes from bonus or overtime. What they'll probably do is look for a track record of how long you've been earning that overtime or bonus. Is it consistent? Is it paid monthly, or is it quarterly, or is it just whenever your employer needs you to go in and do a little bit extra work? How long have you been in the employer? Can you show a 2-year track record, for example, of receiving that income? And they'll look at your contract as well. So, is it an actual employed contract? Are you on an hourly rate? Are you on a 0 hours contract? And all of these things will kind of be looked at differently according to the lenders that you're considering. So the wonderful thing with mortgages is you'll have all these headline rates that are flashed up in the bank's windows or on the internet, but it's your circumstances that kind of determine which ones you actually get, which banks you can approach. Typically, if you're looking to use overtime or bonus to top up your basic in terms of how much you can borrow, I would say factor in 50%. Some lenders will take in more, but just to make sure that you're not kind of maxing out how much you can borrow, and then finding that you've gone for a house that's actually slightly over your borrowing entitlement. If you work on 50% of your sort of maybe average year's overtime or bonus on top of your salary, that typically would be what most lenders would accept. Other income that lenders will take into account is benefit income. So you might have universal credit, you might have child benefit, you might have disability living allowance. Again, some lenders will take these into account, some won't. Universal credit's an interesting one, because sometimes you might have housing benefit as part of your universal credit award, and then no lender will take that into account at all, because it's for rental property. So that is something to bear in mind if you're just plugging in that kind of high level figure from the benefit statement into the affordability calculator, is you need to deduct how much you're paid for housing benefit. Also, your benefit may be based on a single income. So if currently you're a couple, but you both live in separate households, your universal credit award is going to be based on one income. Lenders will not take that into account if you are buying a mortgage on a joint basis, because your universal credit award is based on household income. So the lenders will look at what your household income is going to be once you have moved into that house, and if it's over the threshold for claiming universal credit, then they won't take that into account. Similarly with child benefit, that again is something that many lenders will take into account and they can use to sort of boost your borrowing entitlement. But if when your mortgage becomes a joint household, the joint household income is over the £50,000 roughly cap for receiving child benefit, again they won't take that into account either. So these are all things that you tend to find out once you've put your offer in for the house, once you've put your mortgage application in, once it's been into underwriting. So the last thing you want is for the underwriter to come back 3 weeks after you've made your offer for your house and say, well, you know, your decision in principle did offer you X amount, but we can't take into account all these different elements of income you've got, so we're not going to give you anything like that. Kind of leaves you high and dry, and that's the last thing that you want. Self-employed income we'll do as a different video clip, because we could be here for some time. But any questions, pop them in the comments. Happy to answer anything that you want to run past me. Yeah, good luck.